Hi everyone, so today we are solving November 2018 variant 2 paper 1. In the first question they say which statement by the company is normative. We know what normative is. Normative is basically what we call a value judgment, which means we are giving what we call an opinion rather than a fact. And remember, facts can be right and wrong, but opinions, you can't prove them right and wrong. So the answer for this one will be B. The business has fallen behind competitors and need to improve its ethical standards. And the reason why I'm saying this is that it's an opinion of somebody. Somebody saying that it's fallen behind its competitors and needs to improve ethical standard, which means need to improve means it's a value judgment for somebody. The rest of the statements, we can actually prove them right and wrong. So for example, in the past 3 years, we have carried out biggest merger acquisitions in the group's history. We can prove that right or wrong, whether it was biggest or not. The growth of the business has been in retail and financial services. Again, you can prove it right and wrong. And even this one, D, the structure of the business has been simplified, is a fact rather than an opinion. So the right answer in this case is B. In the second question, they say the diagram shows an economy's PPC for good X and Y. What is the opportunity cost of moving from point R to S? When I move from point R to S, I'm getting more of X. So there is more of X that I get, but I lose something of Y. And this, what we lose of Y, is what Y1 2 is to Y2. This is what we lose of Y in order to get more of X. So what is the opportunity cost of getting more of X? Because I move from R to S, I get more of X. And the answer is y1 to y2 of y. So the right answer would be D, which is y1 to y2 of y when I get more of X. In the next question, this is this: from 1995 to 2000, each of the countries listed below moved towards the market economy through privatization programs. Which country made the slowest rate of transition? So they gave us private sector share of the GDP, and if you look at these countries, you are looking at different sort of ratios. For example, for Czechia, there is 95, number is 70 as a ratio versus 80. So what the way we solve this question is basically we find out first of all the difference, and then from difference we find percentage change. So for example, in the case of Czechia, what happens is that it is 80 minus 70 is the difference divided by 70 times 100 will tell us what is the percentage change. If the percentage change is the lowest, then this means that this is a country which has made the slowest transition or has the slowest rate of transition. Rate means that we are finding percentage change. Remember this, guys, and that's why this is a key word to remember. Whenever there's a rate question, we're looking at a speed or change or percentage change. One quick way to look at this is, for example, the difference here for all these countries. This is 10, this is 15, this is 20. Now, if you look at this, this is also 10, but the denominator is the biggest when it comes to Czechia versus Hungary and Romania. And the answer here is actually A, because if I find the number will come out to be roughly 14%. When it comes to other countries, this is roughly 14%. This would be roughly 16%, versus here it's 15 divided by 45 or 33%, and similarly here would be 20 divided by 60, that is roughly, in fact, same 33%. So what I'm going to look at is basically the slowest rate of change is happening in Czechia, which is 14%. So the right answer here will be A. Question number 4 says, a businesswoman sets up a charity to provide toys for young children of low-income families. Which the most accurately describes these toys? Well, when you look at toys, these are what we call private goods, and the reason why they're private goods is because they're both rival and excludable. What is rival? Rival means consumption by one person will leave less for another. So, for example, if somebody buys toys, which means less of it will be available for other people, number one. And number two, they're excludable, which means whoever has paying for it will ultimately get the goods. So when this businesswoman is setting up a charity and she's buying toys, which means less of it is available for somebody else to buy, A, and B, because she's the one who's buying it, she will decide who will ultimately get the good. Although it will be free for the kids who ultimately get the good, but it's still a private good because it's rival and excludable. Free good, by the way, by definition means there is no price or opportunity cost, which is not the case here because there is an opportunity cost. If you make more toys, for example, less of the resources will be available to make something else. So that's why A is wrong. Question 5 says, what will happen to the industry supply curve if a new firm enters the industry? Well, if the new firm enters the industry, the whole industry supply curve should shift to the right at any given price. Why? Because the entry of new firms will result in more output to be produced at each and every price. So if I make my industry supply curve, if this is my supply curve S1, there will be supply curve shifting to the right, which means that each and every price there will be more output produced. So that's why B is the right answer. Question 6 says D1 shows an individual demand curve for public transport, and this demand curve is shifting from D1 to D1 to D2. Now this is a different kind of a demand curve because at low prices the fall in demand is, for example, very low, versus at high prices the fall in demand is higher. So it just means that at higher prices there is kind of like more impact on demand than at low prices. So what could be a possible reason? Well, the possible reason could be D, the quality of public transport declines. If the quality of public transport declines, and if you are paying a high price, then it will impact you much more than at low price, where you are going to be not so concerned because you're paying a low price to start off with. But people who are paying a high price will actually find the loss of quality to be a big problem, and therefore there will be a larger decline in demand. The reason why C is wrong is because the price of public transport rises. This will be a movement along the curve versus a shift of the curve. While in B, the individual is banned for driving means the demand for public transport should go up rather than go down. And A says the cost of running the individual car rises. Well, if the cost of individual cars rises, the demand for public transport should go up rather than going down. So A is also wrong. So the right answer in this case is D. The quality of public transport declines, which is why at higher prices there will be a larger fall in demand. Question 7 says two goods X and Y have a positive cross elasticity of demand and an upward sloping supply curves. What will be the effect of a reduction in the price of good Y? Well, if two goods have a positive cross elasticity of demand, this means they are substitutes to each other, which means that if there is a reduction in the price of Y, then basically this is what will happen. This is, let's say, demand and supply for your good X, and let's say this is demand and supply for good Y. Now, if there's a reduction in price of good Y, then let's say that's happening because supply curve is shifting to the right. A reduction in price of good Y will lead to a loss or a fall of demand in, for example, good X, because they both have a positive cross elasticity, which means they are substitutes. Now, this fall in demand means that the price will also fall for good X. So C is the right answer. Question number 8 says, which statement best describes the meaning of price elasticity of supply? Well, price elasticity of supply is basically the responsiveness of quantity supplied to a change in price, and that's why it tells us how much supply changes when there's a change in price. So we're looking at the price of a good to change, and we're looking at how much is supply responding or changing to a change in price. So C is the right answer. In question number 9, they say that the table shows changes in the consumer's expenditure on various goods when our income increases from 20,000 to 24,000. So there is a rise in income from 20,000 to 24,000, which is equal to roughly, in fact, which is equal to 20%. So first of all, I'll find out what is the percentage change in income, which is 24,000 minus 20,000 divided by 20 into 100, which is going to be 4/20 or 20%. Now they're saying this, that assuming all else remains unchanged, for which goods is the consumer's income elastic demand greater than 1? So to find income elastic demand, we know this percentage change in income, percentage change in income, a percentage change in quantity over percentage change in income is what we look at, right? We know the percentage change in income is 20%. So I'm going to look at 20% to be in my denominator. If 20% is my denominator, the only way the YED will be greater than 1 is if my numerator is more than 20%. So the value that I need to look at, because they've given us the amount of spent on good, and therefore I'm going to find out the percentage change for all good y wxyz, but I'm going to look at wherever there's a percentage change of quantity sort of demanded to be more than 20%. So the only value that can come here, which is more than 20%, is this one, because 248 minus 200 is more than 20%. In fact, it's 24%, while this is less than 20%. This is not rising at all, and this is falling. So Z only is the right answer, because 248 minus 200 over 200 is 48 over 200, and I know 40 over 200 is 20%, so this is 24%. So that's why 24% over 20% will lead to YED greater than 1. In question number 9, they say the diagram shows the market for cocoa, which is a normal good. So a normal good is one where the income go up, demand should go up. Initially, the market is in equilibrium with price PE. So the price is PE and quantity bought is QE. Now what is happening in this case is that demand is going up and supply is going down. So they said this here, that which sequence of event 1 followed by event 2 must have occurred in order to move through the new equilibrium. Well, we need to look at for events where the demand is going up and also supply falling. So a decline in the popularity of cocoa will make the demand go down rather than go up, so that's not right. A decrease in disposable income will make the demand to actually go down because it's a normal good, so it can't be true. An increase in disposable income could be the right answer because demand will go up since cocoa is a normal good. A successful advertising would also make the demand to go up, so we're looking at C and D as the right answers. But if you look at D, an increase in taxation of cocoa would mean supply will fall, which means this could be the right answer. But an increase in the number of cocoa producers will make the supply to go up. So the right answer is D in this case, where taxation will make the supply to fall and advertising will make the demand to go up, and we will go to point X here. In question number 11, they say the good X and Y are complements and I have an upper sloping supply curve. So let's draw a demand and supply curve for both these goods. Let's say good X and Y are these, and they have an upper sloping sort of supply curves. What will be the effect on the equilibrium price and quantity of good X if an increase in supply of good Y? So if this is good Y, if there's an increase in supply, the price will go down. If the price goes down, let's say, of good Y, and good X and good Y are complement to each other, we know this, that the demand will go up for good X. So quantity of X that will be bought will go up because demand goes up, and the price of X can also go up because the demand is going up. So in this case, question number 11, our answer will be D. So when the price of complement goes down, the demand for the complementary good will go up. Let's say if this is tea and milk, if there is more supply of milk, price of milk goes down, automatically people will be finding it cheaper to consume tea, and that's why demand will go up, and therefore the quantity and price will change because of that. In question number 12, they say what is generally considered to be one of the advantages of using the price mechanism as a rationing device. Now, rationing device means that goods are distributed or given to people according to what they're willing to pay,
and able to pay. When the price of a good is high, only few people will be able to afford the good, and so therefore whoever has the money and has willingness to pay will get the good. And similarly, if the price is too low, more people can buy the good because the good is not relatively scarce. So C is the right answer, where no one can be prevented from consuming a good if they're willing and able to pay the market price. The idea goes this, that in a free market, the market force, the demand and supply will determine the price. The price, if it's too high, only few people will be able to buy the good.
In question number 13, they say the diagram shows the competitive market in equilibrium with price P and Q. Which area represents the producer surplus? Well, producer surplus is all the area under the market price above the supply curve. So our producer surplus will be this area, while consumer surplus is area under the demand curve above the market price. So that's this area. So PWU is basically your total sort of producer surplus. Now in this question they say this, that they're subtracting OPWQ. So OPWQ minus OUWQ will give us our area PUW. So the answer for 13 will be A. In question number 14, they say this: the government fixes a maximum price for wheat flour below the market equilibrium price. After the maximum price, which statement is not correct? But when you put a maximum price below equilibrium, it will be what we call an effective maximum price. So when you put a maximum price below equilibrium, like for example P max, there will be a shortage of Q2 minus Q1. Now that shortage results in basically producers' income to fall, because previously if the market price was P0 and quantity was Q0, producers were making P0 times Q0, but now the producers will only make P max times Q1. So definitely what statement is wrong, and the answer is A. Producers' revenues increase. In fact, producer revenue will not increase, producer revenue will decrease. So A is definitely the right answer because the statement is wrong. For all other statements, for example, B says some consumers may encourage illegal sales. That's true. Black market may happen. The quantity supplied of flour will decrease, and that's also true. Quantity supplied will go down from Q0 to Q1, so that's also a correct statement. And the last one is there will be excess demand for flour, which is also true. Q2 minus Q0 will be what we call excess demand, but total excess demand will be Q2 minus Q1. That's the shortage that will happen because now less producers will sell the good. In question number 15, they say that income tax of a country has two elements. The first 20,000 of earned income is not taxed. Any income earned above 20,000 is taxed at 20%. What would be the correct description of this tax structure? Well, the way we go about doing is that let's take two cases. One person who's earning, let's call this person 1. Person 1 is earning, for example, 30K or 30,000 rupees or dollars, and let's say the person 2 is earning, for example, 40,000. Now I'm going to subtract 20,000 from these guys because first 20,000 is not taxed. So I'm left with, for example, 10,000 of taxable income here, and I'm left with 20,000 of taxable income here. Now when I put a tax rate of 20% from both the individuals, or on 20% of both individuals, 20% of 10,000 will be 2,000, and it will be 4,000 in this case, which would mean I'm looking at basically, if I look at the tax rate now, I'm going to use this taxable income of 2,000 and divide it by 30,000, versus I'm going to look at 4,000 divided by 40,000. So my tax percentage comes out to be, for the guy who's earning $30,000, to be 6.6%, because 2,000 divided by 30,000 times 100 is 6.6%, versus for individual 2 who's earning 40,000, the tax percentage will be 10%, which means as my income go up from 30,000, let's say, to 40,000, my tax rate is also going up from 6.6% to 10%, which means a progressive tax on incomes for more than 20,000. So you can take another case as well, and you can find out the tax percentage, and if the tax percentage goes up as income go up, this is a progressive tax. In question 16, they say this, that in 2014, Egypt reduced subsidies on fossil fuels such as gasoline and diesel. The diagram shows the initial equilibrium point X. What will be the new equilibrium? Well, if you reduce subsidies, supply curve will shift backward. So new supply curve will be this one. The demand remains the same, D1, and the answer will be, in this case, B, as the new supply curve will be S dash, which is basically removal of subsidy. In question number 17, they say, what is an aim of a transfer payment? Well, transfer payments are payments which are made in order to give money to people without any exchange of goods in return. So, for example, unemployment benefits could be an example of a transfer payment where money is moved from given from government to people and they don't expect output in return. And the reason why you want to do those transfer payments is because you want to allow more distribution of income to become more fairer. So this allows government to alter the final distribution of income to make it more fairer. So transfer payments are payments which are made in order to distribute your income more fairly. In question number 18, they say there have been recent calls for UK government to nationalise its railways. What would not be a reason for nationalising the railway? Well, one thing is for sure that railway is not a public good. Why? Because public goods are basically rival and excludable. Non-rival and non-excludable. And we know this that railway is both rival and excludable. Why is railway rival? Well, because if one person sits on railway, less of the seats will be available for somebody else. So this is rival, which means it's not a public good, and also it's excludable. If you don't have the ticket, you don't pay for the ticket, you will not be allowed to board the train. So the idea goes this, that if you are making a call to make it nationalized, the reason can't be it's a public good, because it is actually a private good. Let's look at other options. Private rail companies often charge high ticket prices. That could be a good reason to nationalize. Private rail companies may exploit monopoly power. That's also true. They can charge a high price and consumers may have to pay for it because they have a market power. Railways are an essential part of national infrastructure. That's also true. All three reasons are very good reasons for making sort of train or railways to be nationalized. In question number 19, they say the diagram shows a shift in the aggregate demand curve from AD1 to AD2. The AD curve is shifting to the right. What might have caused this shift? Well, in this case, if the AD curve goes to the right, there is a rise in C, I, G, or X minus M. So any rise in C, I, G, or X minus M will make the AD curve shift to the right. So let's look at answer choice A, a fall in the budget surplus. What is budget surplus? Well, budget surplus is simply T minus G. If budget surplus is going down, which means there could be a possibility that there is more probably government spending that can happen, and if that is the case, then one could argue this, that AD can go to the right. Why? Because if this T minus G is going down, this means this negative G or government spending must be going up. So this could be a possible answer, and therefore A is the right answer. Let's look at other options as well. For example, a fall in trade surplus. Trade surplus is simply X minus M. So if X minus M goes down, then therefore AD will go down. So B is wrong. A rise in imports, M goes up. Well, M goes up, AD will fall. So that's also wrong. A rise in interest rate results in basically what we call consumption to fall and investment to fall, and therefore AD to fall. So therefore that is also wrong. In question number 20, they say the table shows the consumer price index and national output at current prices in 2014 and 2015. If you look at the table, 2014 CPI is 100 and output is also at 100. So this means this could be our base year. As compared to our base year, the next year, output has gone up by 10% in terms of current prices, which means not controlling for inflation, but CPI has gone up by 20%. So if I want to find out my real output, I will subtract our 10%, which is this national output at current prices growth rate, minus the rate at which prices are changing, which is 20%, which means real output must be going down by 10% because prices are rising faster than the output. Prices rose by 20%, while national output rose by 10%. So real output is going down by 10%, and that's why C is the right answer. The money national output is basically our national output at current prices. Money national output is not going down, but in fact it's going on only up by 10%. Money national output increased by 20%. That's also wrong. It went up by 10%. Real national output, it did not go up, but it actually went down, and that's why other answer choices are wrong. In question number 21, they say between June and end of July 2016, the UK pound sterling depreciated by 11%. So exchange rate is going down by 11% as compared to your trading partners. The diagram shows the original aggregate demand and supply curve. So we know that when the exchange rate goes down, exports become cheaper, imports become expensive, and that may cause X minus M to go up. So AD curve will shift to the right for sure. So that's one thing. The second thing is basically because imports are going becoming expensive, price of imports will go up. Therefore, cost of production can rise if key inputs are imported, and that could cause AS to fall. So AD is rising, AS is falling. We're looking at A as the right answer in this question. In question number 22, they say which item is not included in the current account of the country's balance of payment. Well, current account of the balance of payment will not include D, the purchase of foreign assets, because that foreign assets purchase will be part of our either capital account if it's fixed assets, and if it's financial assets or if it's assets for investment purposes, they will be part of our financial account. But in our current account, we will not include the purchase of foreign assets. In number 23, they say this: a government wishes to raise the value of the external exchange rate of its currency. What should it do? Well, if you want to increase the exchange rate of the country, you could increase it by raising interest rates, because we know this: when we raise interest rates, the hot money flows in, and that results in demand to increase, supply to fall, and therefore exchange rate to rise. And the reason why this happens is because a lot of people will invest in your country, both the domestic individuals who will bring their money out back from other countries, so supply will fall, and foreigners will also demand more of your currency because they want to put money in your bank. So raising interest rate is a way to bring the hot money to flow in, and therefore exchange rate to rise. In question number 24, they say country X conducts 60% of the trade with country Y and 40% with country Z. So this is country X that is trading 60% with country Y and 40% with country Z. The initial value of the trade weighted exchange rate is 100. So the index is at 100. What will be the new trade weighted exchange rate if the index value of his currency falls by 20% against country Y and rises by 10% against country C? So this is basically what we call trade weighted index, and the way we find out is just that I'm going to say minus 20% times the weight, which is 0.6, plus 10%, which is country Z, times the weight, which is 0.4. So minus 20% times 0.6 plus 10% times 4, and the answer will be minus 12% plus 4%, which is equal to minus 8%. So if the index was at 100, the index will go to minus 8 or 92. So the right answer will be C in this case. So 24 will be C. In question number 25, they say the index for a country's terms of trade changed from 100 in 2015 to 104. So the index of terms of trade is going up by 4%, which means PX must be going up as compared to PM on a relative level. So what could have caused this change? Well, the answer for this one will be C, an appreciation of the country's currency. Why? Because if the exchange rate is going up, if the exchange rate goes up, exports become expensive, imports become cheaper, and terms of trade, which is simply PX over PM, well, PX is going up, PM is going down, and therefore terms of trade will be going up, which is what is happening here. In this question, they say this: the table shows the production possibility of cloth and food in 4 countries using all of their resources. So country V, for example, is making can make 40 of cloth, or 8 of food, while country X can make 28 of cloth or 4 of food. So they say this: that if the world exchange rate is 1 unit of food for 6 units of cloth, with whom is V likely to trade? So if I look at V, the opportunity cost of V is 8F is equal to 40C, which basically means 1F is equal to 40 divided by 8, which is basically 5C. So this is the opportunity cost of country V. While the exchange rate right now, the world exchange rate is 1F is equal to 6C. Now, any country which has an opportunity cost which is more than 6 for 1F will be a country that is very likely to trade with country V. So, if I look at, for example, country X has 4F is equal to 28C, which basically means 1F is equal to 7C. So if I look at this one, this opportunity cost is more than our opportunity cost here, which is 1F is equal to 6C. So if I'm country V, my opportunity cost for 1F is 5C. The exchange rate is 1F for 6C, which will suit me because I'm getting more C, while any country, like countries for example, which has more than 6C as an opportunity cost, will be the one that will trade with me. So definitely X will trade with me because the opportunity cost is more. So remember this, that exchange rate, as long as it lies between the two opportunity costs, which is the case here, the exchange rate is lying between the two opportunity costs, 6 is between 5 and 7, is a country that we will trade with. What about country Y? Well, country Y is basically 8C is equal to 2F, or 1C is equal to, or rather 1F is equal to 4C. So that's something which will not happen because the exchange rate has to be in between the two opportunity costs, and this one is in between the two opportunity costs, it's before 5C. Similarly, for country Z, the opportunity cost is 1F is equal to 1C, which is also doesn't going to make sense because we want anything beyond 6. So that's why X is the only country that we'll trade with, and therefore B is the right answer. In question number 27, they say the diagram shows the domestic and world supply for a good. This is the domestic demand and supply. This is the world supply. So Q5 minus Q1 is the total sort of import when there is no tariff. But when you put a tariff, Q4 minus Q2 becomes the level of import. The government imposes a tariff on imports of the good. What will happen to quantity imported? Well, quantity imported previously was this much, Q5 minus Q1. Now it will fall to this much, which is Q4 minus Q2. So it will fall from Q1 Q5 to Q2 Q4, which means B is the right answer. In question number 28, say what is an example of a supply side policy? Well, a supply side policy is a policy that is designed to make the aggregate supply curve shift to the right, and therefore it results in productive potential of an economy to go up. It's a policy that can basically promote your businesses and make the cost of production to fall and make the business more efficient. So that's why D, a subsidy to businesses to promote the supply of training courses, could be a good answer because more productive potential will increase as employees will become better trained and so on. In question number 29, they say in a country, the Marshall Lerner condition for improvement in the trade balance is satisfied in the long run, which is basically true. That's what we call the J curve, because quantity of imports and exports are slow to respond to price changes. The government devalues the currency and reduces the trade deficit. Which curve indicates the proper behavior? And the answer is it's a J curve. It has to be a J curve. This B is a J curve where initially when we devalue, our currency will our current account balance will worsen, and it will then improve to, let's say, this point X. So initially we are probably going to be at point A, then we go to B because the devaluation will make our X minus M fall in the short run, but improves things in the long run. Improvement is happening in the long run, and that's why B is the right answer. In question number 30, they say which policy makes this most likely to be effective in the short run for reducing inflation in a closed economy? Well, if it's a closed economy, there is no X minus M. So X minus M is not happening. So your AD is equal to basically C plus I plus G. Well, if you look at the policy, the answer will be C in this case, increasing the budget surplus. Because if you increase the budget surplus, basically Budget surplus means T minus G, where T is going up or G is going down. And that happens, G goes down, AD falls. AD falls, clearly you will see price level to go down. Similarly, if you increase the interest rates, consumption is going to fall, and even investment is going to fall because cost of borrowing will go up and incentive to save will also go up. So that will also make the AD to fall, and therefore the price level to fall. So the right answer will be in this case C. The reason why D is wrong, because when you increase money supply, your interest rates will fall, and that will make the AD go up. So that's why this D is wrong, because increasing the budget surplus is what we want, and not decreasing the budget surplus. So D is wrong because of the idea that when you increase money supply, your AD will actually go up rather than going down.